Okay, all right. Today we are talking about this 6 ringgit versus 2 ringgit, right? How to avoid buying Padini at 6 ringgit and why some smart investor would be able to buy the stock at 2 ringgit. So this is the topic we are talking about. So my name is Casey Lau and we have Ian Tai here. Ian is the co-founder of with me together for the Dividend Vault and also Growth Vault. Let's start the share screen. Do you want to do that?
Yeah, sure. Not a problem at all. So let me just quickly share with you my screen. Okay, so this is it. 6 ringgit versus 2 ringgit. How to avoid buying Padini at 6 ringgit and why smart investors would invest in Padini at 2 ringgit. Okay. And of course, there's a disclaimer. So I guess
You guys can just
actually
pause the video and watch the disclaimer. So let's skip this page. Next
all
one.
right.
So first, I guess we need to know about Padini, right? It's quite a well-known company in Malaysia, but let Ian explain a little bit about it.
Yeah, sure. I mean to say Padini Holdings Berhad, right? So it is a fashion company where most of us, if you are living in Malaysia, obviously you will know Padini because it has a lot of stores throughout all the major shopping malls. So even the shirt that I'm wearing right now is actually from Padini. So Padini is a fashion company, listed on Bursa Malaysia in 1998. It currently has 174 outlets. So this is actually a figure where I have calculated from the annual report, which is the latest one, which is 2023. So currently Padini is well known for, of course, Padini, the Padini brand, but actually it has other brands such as, I mean to say they have other sub-brands like Padini Authentics, P&Co, PDI. But apart from the Padini brand, it also owns the Vinci brand. And this is something that what most people may or may not know lah, depending on whether how well versed you are in the investment community, is that sometimes when you go to the shopping mall, you will see Padini on one side, and then you'll see another store which is Brand's Outlet, and then for most people, they think that Padini is Padini, Brand's Outlet is Brand's Outlets. They have no relations to whatsoever with each other, right? So the thing is that they're not. I mean to say they're not that case lah. Actually, if you see a store where you have Padini and then you have Brand's Outlet, they are of the same company. All right, so they
Same
are owned by
company. Yeah, all the
same
money you
company.
spend on both stores go to the same place.
Yes. So it's like if let's say you say I like Padini, I don't like Brand's Outlet. Never mind. Padini Holdings Berhad will earn a revenue from there. But if you say I don't like Padini, I want to go to Brand's Outlet, also can. Padini is still earning the same revenue, right? So these are the main brands that we can see, which is owned by Padini. But these brands are actually operated under 5 key subsidiaries lah. All right. And the subsidiaries are as followed. Over here, I'll give you a breakdown of the revenue so that we will know an overview of how Padini actually makes money. So basically, it's just 5 key subsidiaries. Okay. So the irony is that does Padini make most of its money from Padini? Well, the answer is not quite lah, because there's this subsidiary called Yi Feng Hong Malaysia and Singapore. So this is actually the company that operates Brands Outlet. And this one, right, if you can see here, it accounts for 41.6% of Padini's total revenues in 2023. So this is actually quite a huge chunk of the revenue lah. Okay, so it's almost like half of Padini's revenue come from Brands Outlet. Then only we can talk about number 2, which is the second subsidiary, which is Padini Corporation Sdn Bhd, which accounts for 34.2%, which is over here. And then we have Vinci Ladies. Okay, so this is actually all the ladies fashion wear. So this is about 11.6%. And subsequently, we have Seed and Mickey House. All right, the kids brand over here, which accounts for 10% and 2.4% of the revenues in 2023 respectively lah. So if you want to say which of the 2 or 3 subsidiaries are key to Padini, then I would say it is Yi Feng Hong Malaysia Sdn Bhd, which operates brands outlets, and as well as Padini Corporations in Johor Bahru. Yep. So these are the
So
main
these are the main breakdown.
breakdown lah, and the main overview of what Padini is as of now lah, as we create this YouTube video.
Yeah, looks like more people spending money on brands outlet rather than Padini itself. Okay.
Mhm.
Next slide, maybe.
All right. So next, I guess after the business breakdown, right?
Mm.
The next one we are gonna do is to have the financial breakdown. Okay. So the reason why we create this YouTube video is to actually create educational content for value investors. Okay. So we are not so much of a trader or a speculator. All right. We have nothing to do with the short term, but it's actually more towards the long term that we are all about. So therefore, just now we are talking about the business side of things. Now we are looking at the finances. So typically finances, we are going to look at two parts. Okay, the first one is actually the financial results, which is the income productivity of the stock. And then the second one, we are talking about the financial stability, which is actually the balance sheet side of things. Okay. So on one hand, which is part one, we want the stock to be financially we want the stock to be income productive from its businesses. And on the other hand, part two is actually where we want, while the company is profitable, we want to make sure that the company has a strong balance sheet. Okay.
Yep.
And it has a track record of doing that. So let's start with part one, which is the income productivity side of Padini. So over here we have revenues. So as you can see, this is actually the group revenue for Padini, which is the combination of all 5 subsidiaries that I've just mentioned. So this is how it looks like. So I've gathered this from the annual report of Padini, and what we can see here is that Padini has actually grown its revenues for the long term over here. So if you want to backtrack all the way up to 2007, it has actually grown its revenue from 317 million ringgit, and it has kind of like 5 or 6 times its revenue all the way up to 1.82 billion. But of course, if you just want to calculate the 10-year CAGR, our starting point would be from 2013. So over here, we can see that if you want to calculate the 10-year CAGR, then of course we can take this figure, which is 790 million ringgit in 2013. And then 2023 is 1.82 billion. Then from there, we'll get a CAGR of 8.72%. But of course, we do note that there's an exception to this growth over here, because we have Padini, as you can see, as highlighted in blue. This is actually where Padini has actually recorded a decline in earnings. But this is actually to be expected, simply because 1, 2, and in fact, you can say that this third year, this 3 years period, right, is actually due to COVID-19 lah. So that's why the finances over here has been impacted in these 3 years lah. But I guess COVID-19 is just temporary. It's a one-off event. It's very important for investors to know that I believe lah, as an investor, what I will want to say is that it is important to assess the company's actual ability to generate revenue in normal business condition. So whenever there's a one-off abnormally, then we kind of like just avoid it lah. We kind of like just ignore it, because we know that this is actually one-off. What we want to do is to assess the actual business condition of the company.
So this the one-off that is really like killing off the company. So, but in this case, not right. They are back on track already. So now their revenue increased. So how about the earnings? Does it make more money for the investors?
All right. So when it comes to earnings, right, it looks something like this. So as you can see, the growth in the revenues, right, has also contributed to the growth in shareholders' earnings. If you can see over here, if you want to backtrack from 2007, it has grown from 31 million ringgit, and in 2023, it has generated 223 million. So from here to here, which is more like a 16-year period, you can say that it has grown by 7 times its earnings.
Even in the down year, they are still making money, right?
Even in the down year, like 2020 and 2021, Of course, Padini is actually, there are there are maybe 1 or 2 quarters that they are not profitable, but that's because of MCOs.
CEO, right? All expenses still going on, but no sales. Wow, crazy, right?
Yeah, I mean to say we can't fault them lah. It's because it's like government say you can't do business, you can't open your shop and do business. Then what do you expect, right? So of course, so that in that case, we give them a pass. We give them a leeway. But in other normal, much more normal circumstances, then they have been very profitable. Okay, so there's a slight typo over here. So it's reduction in earnings in 2020 and 2021 because of COVID-19. Okay, so in terms of profits, it has in overall, if you see a bar chart like this, which means to say that the company has actually generated consistent growth in profits.
Now, when we see the earnings coming in, but does it convert to actually cash? So I guess the next thing we want to look at is what?
Of course, sometimes profits is not everything. Usually to be a much more conservative or savvy investor, we don't just look at profits alone. We want to make sure that profits are very important, but more importantly, we want to see that whether or not the company has cash flow coming in. All right. And in terms of cash flow, this is how Padini looks like. Okay. This is actually very important because if let's say a company has been very profitable, grows its profits like over the long term, right? But then it doesn't generate any cash flow, then of course this to us is a red flag lah. Profits without cash flow is a no-no as an investor lah. So you want the company to have profits and as well as the cash flow. So in terms of Padini Holdings Berhad, when it comes to its operating cash flow, so it looks something like this. So we can see that over the past, if you backtrack all the way to 2009, operating cash flow has been relatively positive. If you look at the past 10 years, it has generated 1.7 billion ringgit in operating cash flow. But there's a slight exception over here, whereby after a period where it has generated a lot of cash flow over here, you see, usually it just make about 100-200 million ringgit in operating cash flow. But in 2022, boom, 474 million. They have more cash flow than ever. And then in 2023, they have incurred a slight cash outflow in terms of its operating activities.
So you wonder what happened there, right?
Well, I did some study, so this is actually what happened. So you can see here, so this is actually a snapshot of its operating cash flow, the statement. So operating profit before changes in working capital, it has been quite okay. All right, as you can see, this is by the way 2023, 2022. So this one, so from here to here is obviously an increase. But the real reason why there's a decline in there's a cash outflow over here is simply because number one, they have actually spent too much on inventories lah. Means to say they take all the cash flow and then they start to stock up their inventories lah. Okay, so this could be something which is strategic for them. And of course, number two, I think they will just want to pay off their suppliers lah. That's why there's a decrease in trade and other payables. So there goes another 54 million. And after they pay off their taxes, and therefore net cash outflow is 19 million lah. So this is actually the reason behind the cash outflow for Padini in 2023.
Yeah, hopefully they will normalize in the future.
I believe so lah. Since they choose to, I believe it's strategic because I mean it's their own choice lah, because they could have just don't buy too much inventory and eventually this figure will be positive, right?
Yeah.
But since they choose to do so, then I believe the management team has I mean to say they must have actually strategized something lah. That's why they actually buy so much in inventory lah. Maybe they are confident of their product, that the product is sellable, so they just want to stock up earlier lah. So that actually explains why so much cash outflow from for the purchase of inventories.
Okay, so now we have looked at the earnings, the revenue, and then even the cash flow. So how about the balance sheet? I want to look at like what's the financial status of the company.
All right. So there will be two things that we look at when it comes to the balance sheet. The first one is actually current ratio. So current ratio is very, very simple lah. So just imagine like let's say your total expenses, right? Or let's say the amount of bills that you need to pay plus all the debt servicing that you need to pay, right? It's all together 100,000. And then you have $100,000 in your bank account, cash. Okay. And you have no other things apart from cash. So in that sense, your $100,000 can actually last you for 1 year, assuming that you don't bring in additional income lah. Okay, so 100,000 divided by 100,000, that's 1, which is 1 year lah. Okay, so typically what we want a company to do is to have a healthy current ratio. So if let's say you find a company where the current ratio is almost 0, like 0.2, 0.3, which means to say they are almost at the brink of a financial crisis lah. Actually, they are undergoing financial crisis in that sense lah. So therefore, when it comes to current ratio, usually we just want to be on the safe side. Usually we want it to be above 1. But for Padini, the thing is that when it comes to current ratio, it's always above 1. It's like 2. All right, from 2007 all the way to 2018, it's always above 2.
Yeah.
Okay. 2019, they have 3.9 in terms of current ratio. And the beauty about this stock is that 2020 and 2021, if you look at the current ratio, right, it's at 4 or 5. So during periods of uncertainties like COVID-19, they have a current ratio of 4 or 5, which means to say they have a lot of cash stash aside. But at that period of time, they may not be as profitable because COVID-19, but they seem to know how to store up some reserve some reserve fund.
They're very conservative, right? In this case.
Mm.
So this is more like how we look at our personal level. So like let's say you have a 6 months emergency fund. So all the other stuff are not liquid, but your liquid fund is just like 6 months. Then that means the current ratio is 0.5, isn't it? Right? 6 months, not even 1 year. So but you look at like Padini's one, wow, it's always like more than 2. So it says how healthy they are on the current ratio.
Yes. And of course, this is actually an additional sign whereby if you want to know whether a company has the financial resources to expand, to grow and expand, because growth and expansion, all right, will bring in, I mean, they say at least it's an opportunity lah. It's like bullet for them to invest so that they can actually do something to actually grow their income, grow their sales, profits, and cash flow in the future. And because of that, the stock actually will revalue, all right, over the long term because of that. So if you want to know whether a company has the financial resources, then we can always look at the stock's current ratio. But in the case of Padini, wow, I mean to say you have a current ratio of 4, 5 during pandemic time. It's actually one of those companies that you know that they can actually ride through the storm lah, because they have, yeah.
Yeah, so now we understand that they have very a lot of liquid asset, and then I think the next thing is we want to know are these like borrow money, right? Are these like money that actually they don't have, or they borrow somewhere else? So I guess the next ratio we want to look at is what?
It would be gearing lah, but of course we already know the first clue because previously we know that operating cash flow, every year you got cash flow, obviously every year you got operating cash flow. That's one sign already lah. You can say that the company, when it comes to its financial resources, it comes from its customers lah. Okay, it comes from its business, which is very healthy. But of course, the next ratio is to look at the gearing ratio. But before we look into that, the latest current ratio is actually 4.47, which is already after pandemic. You still have 4.47, which means you have ample of bullets lah to do whatever you want to do to actually sustain a company. Now, in terms of gearing ratio, there's nothing much to say about Padini because if you look at the ratio, right, and these are actually obtained from the annual report, right? You can see that there's not much in terms of gearing lah. You can say that the company is very, very low geared. I wouldn't say even, I don't think they are even conservatively geared lah. I would just say they just don't have gearing lah.
Yeah. Nice. Net cash lah. They didn't
Net cash
borrow
lah.
money lah. Basically nothing lah, negligible.
Negligible.
Okay. So now we have looked through the balance sheet. Very healthy. It's a good company. And what is the valuation, right? Why some people can pay like 6 ringgit for it, and then some people manage to buy it at 2 ringgit.
Okay, good point. So the first thing when it comes to investing, right, is that we want to know if the company is financially strong, is fundamentally a solid company. So that's the first step, ma. Then the second step obviously is to look at valuation. So the thing is that I find it very interesting because some people, when it comes to Padini, right, some of them they may buy it at $5 or $6 over here, which is somewhere in between 2017 and 2018 lah. So it's actually during this period of time where Padini was trading at 5 or 6 ringgit per share, and these are times where people continue to buy. Okay, so I find it very, very peculiar. So the thing is that why some people actually buy here? Of course, there will be people who buy at $2 lah, which is actually here. But first, in order to understand, so here we want to present a viewpoint from a value investor, whereby why is it that people actually buy here, but typically value investors we won't actually buy here lah. All right, so this is actually why we do this video. So let's take a look at and the answer, the clue to it is actually lies in its valuation. So when it comes to its valuation, we can see that so this is Padini at its peak, 6 ringgit and 15 cents over here. So if we quickly do the valuation, so this is actually the latest 12 months valuation, which is like 0.244, or if not, it will be the 2017 kind of valuation. But I believe this will be the 12 months valuation, 12 months earnings per share. This divide by this, you'll give you a PE ratio of 25.2. Okay, so this is 25.2 in terms of PE ratio. Now, when it comes to its dividend yield, its dividends per share is 11.5 cents divided by 6 ringgit and 15 cents. So your dividend yield here will be 1.87%. Now let's put it to context. So the context is that when we calculate the PE ratio, which is 25.2, 25.2 is actually over here. But if you want to compare this 25.2 with the historical past, we can see that over the past 10 years in before 2018, so this is actually a period before 2018, what happened is that the PE ratio over here, okay, it is not as high as, it has never gone as high as 25.2. It's the lowest is actually 0.17, highest is 15.64, and the average is about 11.5. So as a value investor, typically we don't want to overpay, and we tend to actually stick somewhere, even if we want to just look at a period from 2012 to 2017, we may just want to stick over here, stick our PE ratio over here between 10 and 15 to be on a safe spot. So 25.2 over here, it's already it's already for value investors a no deal already. So clearly people who buy at 6.15 never really consider about the PE ratio of Padini at that point in time lah. So that's actually the first clue. The second clue is when we look at dividend yields, the thing is that for dividend yields, so what I've calculated is that the lowest dividend yield is actually 2.93, highest is 7.46, and then all these things are somewhere in between. So the average is about 4.77. So the thing is that at that point in time, when Padini was trading at 6.15, the dividend yield at that time was 1.87, which is here, which means the past investors are actually getting somewhere between 3, 4, 5, maybe 6%. but you're getting about 1.87% lah, which is the lowest lah for you if you actually purchase at 6.15 lah. So clearly this is actually another sign that says that Padini was overvalued at that point in time. So you're not getting the best in terms of dividend use if you buy it at 6.15. So clearly these are two signs whereby Padini is overvalued, and typically for value investors, we don't actually go in. But I guess
so usually
yeah.
that would be the cautions, right? When the price at the valuation is at this level, so it will be cautious for the investors to go in. But you know, the market is not rational sometimes. So what happened during the COVID, right? Does it pique the interest of the value investor?
Yes, I mean to say, just to add a few points, of course, maybe it's because of this lah. You see, Padini start off here, right?
Because it's looking good. Because it's looking good, right?
It went up so sharp, right? So 1.5 to 6.15, right? And then from here, maybe people are thinking that Padini can go to
continue their trajectory, right? Continue the trajectory.
But that's not how it works, lah. Okay, so so in a way, rule number one is when it comes to investing, right? It's never to think that just because there's a rocket like this, the rocket will hit the moon one day, lah. So very rarely it will hit the moon, lah. Okay, so don't bank on that. Now, so this is actually the first part where we explain like why is it why value investors won't buy it at 6.15. But there's another scenario which happens during COVID-19, right? Where Padini was at one point in time trading at 2.08. Okay, so this was at October 30th, 2020. Now this period of time, we have just kind of like recovered a little bit from COVID-19. All right, so it's over here. So COVID-19 is here. That's when all the mayhem happened. But then slowly it kind of like traded between maybe 250, 220, 208. So is this during this period of time lah? So during this period of time, it's a very interesting period because you have the chance to actually pick up Padini at 2 ringgit, 220, or even 250 lah. So if you buy it and anytime here, I'm sure that right now you are sitting at a capital gains position because right now the price is 3.43. But if you buy it at 6.15, I don't think you still recover lah from your capital losses lah. Okay, so reason why is it possible for value investors, right, to have the confidence to buy it at 2.20 or 250? Why? So here's why. Okay, now this is PE ratio. Again, this is the 2019 earnings per share. Why do we use the 2019 earnings per share? This is because we already know that this is COVID-19, there's a lockdown. So what we see is that because at the end of the day, we are buying into a business. So we are assessing the company, or we are valuing the company based on its actual, or based on its true actual performance under normal business environment or circumstances. Okay, so therefore the latest that we can find is actually 2019, whereby earnings per share is 24.4 cents. So if you take 2.08 divided by 0.244, your PE ratio at the time is below 10, which is 8.56. Okay, and then when it comes to dividend yield, because before COVID-19, throughout the years, right, Padini has been paying out 11.5 cents in dividends on a yearly basis. So the thing is that if you buy at 2.08, based on its past track record of paying out 0.115, so your dividend yield would be 5.53% if it recovers lah. Okay, so you're getting around 5% if the COVID-19 pandemic has recovered, and the PE ratio at the time, it's you're buying it at below 10, which is 8.56. To give you a perspective, we have to compare it with the latest 10 years before 2020. Okay, so now we are shifting the goalpost a little bit. So what we can find is that the lowest PE is actually 8.41, highest is 22, the average is about 13.64. So PE ratio 8.56 is actually almost the 10-year low, which happens in 2010, and definitely below 13.64 lah. So which means to say, at this point in time, Padini was indeed undervalued. Now, in terms of dividend yields, the average is actually 4.26. So the thing is that 5.53 is definitely higher than 4.26. And in that sense, right, you can say that, oh, Padini is undervalued in that sense, and you're getting pretty good dividend yields if once the business condition actually recovers. So I would say during this period of time, if you happen to be a value investor and you're smart enough to actually look into all this kind of stuff, you'll definitely have the confidence to actually buy into Padini. Plus, there's also one more thing that I would like to highlight to you, which I would like to go back, is that how sure am I that Padini will recover? So the thing is that, of course, as value investors, we won't be 100% sure. But to add on the security, here I would like to present you the current ratio again, which means to say, okay, it's bad business condition, but how sure are you that Padini can actually sustain for the next 2 to 3 years? The answer lies in its current ratio. As you can see over here, the current ratio is like 4, 5.4, 3.62, which means to say they have very strong buffer. In fact, their buffer is so strong that I think is one of the top. As for other companies, they may not have so much buffer lah.
Yeah.
Okay,
Yeah.
they may not have so much buffer. So which means to say other stocks may kaput first lah. Padini will still be there because of such buffer. And number two, we look at the gearing ratio. You see the gearing ratio almost non-existent. The bank won't come and chase them for money, right? Other stocks may have leverage, may have debt, may have borrowings, but not Padini. So Padini can stay afloat during COVID-19 during this period of time lah, because of financial prudence. So these are additional metrics that actually can provide some level of confidence to value investors lah. All right, to actually step in and buy Padini if they're interested in Padini, of course. Okay. So these are the valuation metrics for Padini when it comes to $6 and when it comes to $2. Yeah, Casey, any add-ons?
Okay, so yeah, I'm thinking like, okay, now we understand how investor thinks. Like we try to buy it when it is undervalued, and we try to not get into the party when the stock is like overvalued. So that's how you avoid buying Padini at RM6, and you can actually have the confidence to go in when it's like RM2. So can we conclude? Maybe what's the main lessons learned from all these?
Yeah, sure. So from this video, right, I mean to say, of course, we are quite late into this YouTube game, all right. But then hopefully we can actually make it up with some very good quality in terms of the content lah, all right. So this is our first video, but here I would like to conclude our first video with 3 key lessons that I find from this Padini episode. Okay, so the 3 lessons are as follows. Lesson number 1, when it comes to investing, right, for us, right, we tend to actually focus on the long-term fundamentals. So as you can see, when it comes to explaining all this kind of stuff, right, we don't actually have technical analysis. We don't have all this kind of charting softwares and all this kind of stuff. Everything is actually based on long-term fundamentals. So like Padini, if you take a look at the long-term earnings of Padini, so Padini has actually multiplied its earnings many times. Like just now we have mentioned about 7 times over here. So over the long term, it has actually grown in terms of earnings. And this has actually reflected in a way when it comes to its stock price performance over the long term. As you can see, Padini was once upon a time not even $1. And right now it's at 3.43. So if you want to multiply with the multiples, of course, it may actually be in tandem. So usually for us as value investors, we don't actually use technical analysis. Rather, we just actually focus on long-term fundamentals. Number two, the thing is that just because you buy yourself a good stock, okay, even the best stock in the world, doesn't matter what you buy, in which market, one reality that we need to be aware of is that fundamentally good stocks, right, can also drop by more than 50% in the short term. So like in this case for Padini, we can see that from 6.15, which is the peak here, to the bottomless, to the most bottom that we can find, which is 2.08. This drop here is actually 66.2%, which is more than 50%. And this happened within a short span of 2 years. So which means to say, during this period, if you happen to buy Padini at 5 or 6, you may actually lose faith in the short term, like 1 or 2 years period. Okay, so do take note of this. And that's why, and that is the reason why value investors tend to do stock valuation, because we don't want to actually buy a stock when the valuation is actually too high, because we want to avoid this scenario where the stock price actually fall at more than 50% in the short term. So one of the key ways to actually avoid this is to do stock valuation. Okay. But of course, even with stock valuation, does this thing still happen? It still happen. That's why we will prepare for it. And last but not least, I will be repeating myself again, which is to do stock valuation to find bargains and to avoid overpaying for a good stock. So over here, we can see that here, definitely people overpaid, but people are not aware because they may not actually do stock valuation. They are not aware that Padini, the PE ratio is at 25.2, which is the highest, and the dividend yield at 1.87, which is the lowest. I'm sure that when people look at this, people don't look at stock valuation, people look at stock price. People see that Padini is actually going to the moon. So they're just hopping onto the rocket, hoping that 6.15 will turn into 60.15. But it doesn't really happen that way, okay? But for stock investors, especially value investors, what we do is that we just move away from the stock price chart for a moment and we do stock valuation. And that is actually how we can actually come in confidently and find some good bargains. And if let's say any value investor actually buy Padini at 2.2 or 2.5, I would say that let me just congratulate you, because right now you are on a capital gains position. And on top of that, you're now receiving the 2.5 cents in quarterly dividends for every single quarter since the pandemic has recovered. All right. So these are the 3 key lessons that I think we should be taking note of as value investors. All right. So back to you, Casey.
Okay, awesome. So thanks, Ian, for the elaboration about Padini Holdings Berhad, and then we learned a thing or two about value investing. And to follow us, I guess you can subscribe to this YouTube channel, and also we have a free retirement portfolio ebook for you, which is free for download. You can go to the link. We'll put this link in the description as well. After you download that ebook, we will send you some links for a free training as well, where Ian is going to do another case study, very thorough, about his valuation on REIT stock, and you will get to know about that. We'll send you more information. So hope to get connected. Thanks for watching.